Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, September 20th, 5:49 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market has been downgraded from weak uptrend with the follow-through day on 8/29. That failed today miserably, so downgrading the market state to mild correction. You can see over here on the trend gauge, as far as leaders go, we've added a red arrow to neutral. Several leaders broke the 21-day moving average today. Short term, the five major indexes downgraded from neutral to bearish/slash downtrend as we broke below the lows of the recent trading range that we've been in. Medium term, still neutral. We still have the slopes of the lines of a few of the big cap indexes trending higher, but neutral with a red sub arrow there. Long term, still above the 200-day moving average on now three of the five major indexes, as mid caps had their first close below the 200-day moving average today. So what happened today? Well, yesterday we had a bullish setup with an undercut and reclaim of the recent lows of the 15-day trading range. And we were holding up. We actually gapped up this morning. We're holding up okay into 2 o'clock, and then immediately, usually when you get these FOMC, um, when the reports come out, when the press conference starts, when he starts answering questions at the Q&A, you vacillate between bullish and bearishness on the day. All bearishness today. The statement was hawkish. Powell's introductory statement, the FOMC statement was hawkish. Powell's opening statement was hawkish, and the Q&A was hawkish, and the market just sold off one weak attempt to rally during all this process, but lower today, killing the rally. In a nutshell, uh, Powell reiterated their plan for one more rate hike. They didn't raise rates today, but he reiterated the plan for one more rate hike by the end of the year, and they cut their outlook for rate cuts next year. He was also questioned a lot by during the press conference about, don't you think this is enough? And he kept saying that they were going to keep their boot on the throat of the economy and inflation, and the market didn't like it. Bottom line, rally failure, new lows relative to the last 16 days, and an undercut of the follow-through day. That puts us back in correction. We're now more than 4% back off of the highs. This reminds me a little bit of Q4 2018, when Powell misread the economy or the sentiment and just went a little bit too far, and we had a very harsh December that capped off a bad Q4 of 2018. Hoping we don't see that again as we're going into the most bullish portion of the year, that being the fourth quarter. But we're currently in the most bearish 2-week cycle of the year, and the market is certainly following that to a T. Here are the final numbers. Our 8 ETF composite, the RG8, down 1.06%. S&P 500 gapped up 0.25%, was still positive at 2 o'clock, immediately started to sell off. 1 week bounce, closed at the lows of the day, down 0.94%. Very similar for the NASDAQ 100. It was weaker than the S&P all day. All 7 of the big 7 stocks closed lower, down 1.44%. Dow, relative strength on a down day, down 0.22%. Mid caps down 0.5%. Russell 2000 small caps down 0.9. Global diversified 60/40 stock and bond down 0.37%. Bonds were mixed today. The long end prices were up, meaning yields down. The intermediate and shorter terms prices down, meaning yields were up, and that kept that's what Powell controls, what the Fed controls. That's the Fed funds rate, the short-term overnight lending rate, but everything looks to that first, and then as you know, we've still got the inverted yield curve. In-house GROTECTION down 0.94%. Cut a little bit more exposure. We'll go over the portfolio. Let's get right into it. Definitely a disappointment, but as I always say, we're prepared for everything at Revere. We've got plans for strong markets, middling markets, weak markets. And what the thing I really want to point out here is that we were playing ping pong along this 21-day and 50-day moving average when they were relatively flat. This was 2 weeks ago to a week ago. We had a failed bullish move higher on 9/14. That was completely undone the next day when we got back below the 50 and the 21-day moving average. The next day, tried to get back above the 21. This is on the 18th. At this point, the 21-day had rolled over and we failed. This morning, with the gap up, we failed again right into the declining 21-day moving average. Just like the market tends to obey an uptrending 21-day until it doesn't, it also tends to obey a downtrending. You can see it happened right here at the end of July and early August. And it's happening again since the slope of the line curled over. We failed into there on Monday. We failed there again this morning. And then if you go to a 5-minute chart, it's very clear what the market did when right here at 2 o'clock when the statement came out. We bounced a little bit right into 2:30 when Powell started talking, and then just waterfall the rest of the day into the close. Market not liking it, and reinforced our recent cautionary stance and raised even more caution for us. I've got a 150-day moving average on here. Let me change this really quickly to a 100-day moving average, because that is on the major indexes the next reference level that we want to keep an eye on. And you can see we held that during the pullback during August, and we're now closer to that when we were during those two pullbacks, just 0.6% away from the 100-day moving average, which is right below this 4,400 level, which has been another reference point during the move higher, during the sell-off 4 weeks ago. And now here we are again at 4,400, closing at 4,402. Let's go to the NASDAQ 100. Similar weakness, ran into the declining 21-day moving average. This morning failed, closing at the lows of the day. It is 1.2% away from the 100-day moving average. And something I didn't mention with the S&P, but let me point it out very clearly now. The ranges that we've been talking about, how we bounced, how we held and bounced and undercut and reclaimed. The lows of the follow-through day on 8/29, you can see a very clear breakdown below them into the close today. That's on the NASDAQ 100 and also on the S&P 500. Undercut and reclaimed yesterday, brutal failure today. Back to the NASDAQ 100 on the daily. And as I said, making lower lows. Still not below the lows of 4 weeks ago when we first bounced after we were correcting. And the 100-day moving average is above that level, both on the NASDAQ 100 and on the S&P 100. So that provides a little bit more of a support level should we get down to that level. Remember the 7-layer burrito that I was referencing a couple of weeks ago? That's from like 4340-ish down to 4300. We'll break the 100-day moving average before we get to there. So, hey, we can upgrade it to an 8-layer burrito. Not that that gives any solace to the bulls after a day like today. Let's go to the Dow Jones Industrial Average. Continues to show relative strength during the sell-off. We see that a lot, but holding the 100-day moving average, got back above, but failed into the declining 21-day moving average today. Now the really bad indexes, mid caps, broke below the 200-day moving average today and below the low of the recent range. IWM small caps Reclaimed earlier today and with the gap up this morning, reclaimed the 200-day moving average, but failed there and made a lower low. You can see how terrible relative strength has been lately. And we also are now seeing some weakness in oil stocks. That's going to pile on as if small caps weren't weak enough. But oil, NRGU, which we got stopped out of yesterday, made a lower low and broke the 21-day moving averages right on this. It's right on this 500 level now. Uh, People just getting a little bit too bullish on oil. I saw a big contrarian trader mentioning that yesterday. So we'll see how that plays out. So those are the 5 major indexes. Let's go to the VIX. Also bad news here as the VIX got back above the 21 day moving average, back above the 50-day and above that 15 level. Recall below the 15 level is where we've had the most success in the indexes going back to June. But back above that level today, right into the declining 100-day moving average. That's the VIX. Let's go to the dollar. Dollar started out favorable, which is lower, had an outside positive reversal though, which is not favorable to stocks. You can see it here on the 5-minute that the dollar got much stronger as the press conference went along, complete opposite of what you were seeing in stocks. Strong dollar, we've said it for a while, is not a good sign for stocks, and it certainly held up today. Really good day early on the precious metals, but by the end of the day, they closed near the lows of their range. Gold barely positive. GDX outside, not outside, but a negative reversal. You can see the gap up here, and then it gave it up after 2 o'clock also as the dollar got stronger. And silver up 1/3%. So still positive closes on there, but certainly worse than their gaps up this morning. What's next? How about bonds? BND, the broad bond index, making a lower low. Bonds were actually mixed today. The higher end rates pulled back, the lower end rates rose. BND is trending below its declining 21-day moving average. Let's go to TLT, and you'll see this was positive but closed at the low of the range. 30-year TYX, TLT is positive, TYX is going to be lower. So we didn't quite make a new high on the 30-year, down 0.61, but we did make a 16-year high on the TNX yesterday. Didn't follow it up today, but closed at the top of the range. That's also certainly a negative, especially for growth stocks. And Bitcoin down 1% on the day. All right, that's our inter-asset correlation. Let's get to the tail of the tape. Changing from weak uptrend to mild correction. And the technical indicators across the board are unfavorable to stocks. So the 5 major indexes, the RG8, the NASI RSI, the dollar, and rates. These are all headwinds for stocks. And now add that to the VIX being back above 15 and above the 21-day exponential moving average. Bull case now with a sustained break below the 21 and a break of the recent range, sustaining the the bear case, or reiterating the bear case. Here's the news. As I said, no rate change, but hawkish higher for longer outlook. Day count broke the 15-day consolidation. We're now in today's day 1 down, 4th day below both the 80 EMA and the 21 EMA on the S&P 500. Our expectations were positive if we're above the 21, but we're not there anymore. So expectations flipped to negative. You can see we broke this 365 support level and just barely held on to 4,400 on the NASDAQ and the S&P respectively. As far as indexes go, money flowed into defensive stocks today, XLP, UV, and RE. That's staples, real estate, medical, and utilities. Early in the day, we had strength in banks that coincided with the small cap index getting back above the 200-day moving average, but by the end of the day, that went lower also. And I mentioned we were mixed on bond rates and yields today. On the downside, Basic materials and the tech stocks. Semiconductors continue their weakness, high beta stocks. And the dollar started off weak, not by the end of the day, though. It ended up in the positive column. So in-house, VRT sold that very small loss, about 3% on a 1% position. And we trimmed our third buy on Uber as we went barely negative on it. We're very uh, conscious of what the cost basis is on any of these recent buys that we made. Uh, Basically, consider this a couple of more paper cuts. Every day we survive until we get to the next rally and preserve our capital, we'll just be in that much better shape when we get there. Want to show a couple of charts that reflects the perils of growth investors, as the wind is just absolutely, when it's in your face on the indexes, you're always at risk of a breakdown on even the best of stocks. Sometimes when the environment's conducive, it's really good. When it's not, play it tight or get the heck out of the way. So this reduced our overall exposure to 0.83%. Neutral is 1.0. That's the S&P 500 with the trimming of Uber and the selling of VRT. Bottom line, FOMC, Hawkish Powell kills the rally. And as I said, shades of Q4 2018. We don't want to see a Q4 like that. Let's show that on the S&P 500. Let's go back to March of 2019. Let's try that again. Let's go back to March of 2019. Here we go on the S&P 500. So this was a case where back in 2018, we actually trended higher nicely during August and September. It was October where things started getting bad, starting with a big break here in the beginning of October, a couple of bounces near the 2,800 level. And this is where Powell made his mistake. It was the beginning of December. I believe it was a FOMC press conference, and he was just way too bearish, and the market sold off really hard right into Christmas. Right before Christmas, he came out and made some comments that maybe he overestimated how bad or was too hawkish, and the market rallied the day after Christmas and took off in the first quarter in 2019. But this was a 20% correction from high to low, and then rallied into the end of the year and picked up in Q1. Just bringing it to mind because, or bringing it up because this was the last time, to my recollection, that it appeared that just a lot of people are saying that the Fed seems to be going uh, just a bit too far. You've got student loans kicking back in. You've got interest rates obviously continuing to be high. You've got these auto strikes and some strikes in other industries pending. The headwinds just seem to be increasing, and the market just absolutely did not react positively to it today. All right, let's do a quick portfolio review and then some perils of growth investing stocks. We'll start off with TBT. This is our interest rate play, down today, closed at the high of the day, though, still riding the 21 EMA higher. Next up, what we stopped out of, VRT, closed barely below the 21. This is really as much a market call. This is one of the healthiest stocks in the market, but as you'll see when I show about 5 charts here in a minute, the healthiest stocks are at absolute risk in a market where the growth stocks are out of favor. Lilly added this recently. That's right at 570. We're down $5 on this. The 21 EMA will be our cut on that. Um, Great thesis, great product. The market wind is in your face. You're not going to make money. Can't make money in the strongest stocks. You can't make money in the market. That's an old Jesse Livermore saying. Tesla had 2 nice rallies during the day on some news. By the end of the day, it was negative. Our latest buy on Tesla is down about 3%. That's a 1.5% size. We're down 1 point. We're down on a 1.5% size. We're down less than 4% on it, I believe. Note the relative strength on this. It's really the best acting of the big seven, but if it breaks the 21, we'll be gone. We've got a 10% gain on, or what's probably below 10% now with the pullback today, but net net, we're positive in this position. NVIDIA, our big gain is dwindled to about 60% from our initial entry back in this area since the top near the 500 level. Um, the 100-day moving average is now above this last couple of shakeouts that it had here in late July, here in early August. Looked like there was one yesterday, but we're back right back near those lows. 400 is the pull the trigger out, pull the ripcord. I am cognizant of the relative weakness there also. Uber, as I said, we've made 3 buys on this. Relative strength line, great there. Once it started to handle in the cup and handle, undercut and reclaimed like a champ yesterday, gave up the 21 today. Less than a 1% loss on that last 2% position. We're still holding 3% on this, giving that the 50-day moving average benefit of the doubt. So that's everything that we own. I did show NRGU. A lot of negative reversals in oil stocks today. They were up early, they reversed lower. Now let's take a look at some of the carnage in a few leading growth stocks. Here's IoT, really nice breakout of a double bottom, held up for a couple days, but look at how this has just come undone from 30 to 25 over the last 6 trading sessions. The perils of growth investors can happen at any time. ELF, a model book stock. Look what this has done the last couple of days. It was down. It's down this week 16%, breaking the 100-day moving average, breaking the 50-day moving average, breaking the 20-week, all the way down to the 30-week moving average. You know, that's a Weinstein line in the sand level, but when the funds decide to get out of it, I mean, look at the big selling bars consistently day after day, 3, 4, 5, 6, 7, 8. This is 9 straight down days in ELF. Next up, Celsius, the absolute poster child leadership for CanSlim. Not today's ERG, minus 8.3%, breaking like a hot knife through butter, breaking the 21-day moving average. Just relentless selling on this today. Relentless. Little bit of a bounce. Closed at the low of the day. IonQ. Just can't have a big growth leader without volatility. You just can't get out of the way of the volatility. The question is, when can you recognize when it's normal and when it's abnormal? IonQ, this broke out above 20 the middle of last week. It's gone from 2150 down to 1480. How much is it down this week? Down 13%. AEHR, we added this to the 2121 list earlier this week after our weekend review. Broke again the 21 like a hot knife through butter, down 6.7%. Yeah, the volume was light, but the price is the price. This has earnings in a week and a half. And that's going to wrap it. As always, like to hear from you. Emails don@revereasset.com. If you're interested in becoming a client, my partner Dan Stewart is at dan@revereasset.com. The phone is 855-REAL-WEALTH, 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. They change quickly, don't they? We went from very optimistic less than about a week and a half ago with our highest beta on this move higher last Thursday, completely undone over the last 4 sessions, and that's the market telling you that the winds are just not in your favor. And Jay Powell put a big exclamation point on that today. Changing character day with the break below the 3-week range, 15-day range since the 829 follow-through day, which was right here. And that's all she wrote for now. And with that, I will wrap up the depressing edition of the Wednesday, September 20th Revere Market Insight video. This is Don Vandenbord telling it like it is. Not always the news you want to hear, but the news you need to hear. Thanks for listening and have a great day.